Hello and welcome to the Business Today show. I'm Udayan Mukherjee. 2022 so far has not been a good year, economically speaking. It started well with all the promise of a post-COVID recovery, but then inflation started to surprise everyone, including the world's central banks. And just when it looked like central banks are beginning to focus on inflation squarely and are set to raise interest rates much more radically than they have thought earlier, and probably will be successful in taming inflation, the focus shifted to growth because the world now starts to worry about whether this kind of monetary policy will inevitably lead to recession in the Western economies, US and Europe, and what that could mean for the Indian economy, where there will be no recession for sure, but could there be a growth slowdown, and how well will we deal with our own inflation problems? Who better to put all these questions to than India's Chief Economic Advisor, V. Anantha Nageswaran, who has joined me now. Anant, welcome to the show and great to see you again.
Thank you, Udayan. Look forward to talking to you.
As I said in my preface, Anant, the two big problems are inflation and growth. And just a couple of months ago, all the worries seemed centered around inflation. But in the last few weeks, it almost seems to have changed completely to a focus on growth and recession. Of the two devils which we are battling globally and locally, which worries you more, inflation or growth?
I think, as you correctly put it, Udayan, in the last 2 to 4 weeks, the focus has shifted to growth concerns rather than inflation concerns. And the reason is commodity prices, particularly that of crude oil, commodity prices have declined meaningfully in the last several weeks. Whether it is the price of crude oil, industrial metals, some food items, and the cost of shipping, the Baltic Dry Index, and even semiconductor prices, they all have begun to come down. And the feeling is therefore central bank tightening would slowly bring inflation back under control. That feeling has now started to emerge. Even Mohammed El-Arian, a well-known economist and a bond market strategist before, he has now said maybe the inflation rate has peaked. And even in India, because of all these global developments and due to the monsoon becoming very active, the concern now will also shift towards growth because inflation may have peaked at 7%. So globally, I think it is right that in the last 4 weeks, the concern has shifted towards growth. Suppose oil prices had remained very high in the 120s and 130s, then the concern would be on both. Even now, of course, it is quite possible as we head into the winter months in Europe and North America, inflation concerns may resurface if energy commodities go up in price. But right now, I think the feeling is that inflation may be getting tamed precisely because financial markets and commodities markets have begun to price in the impact of the higher interest rates on economic growth. And that is one of the reasons why commodity prices have corrected meaningfully. So between the two, as we speak, the concern indeed has shifted towards growth decline rather than inflation remaining persistently at very high single digits or in double digits in Europe and North America.
So let me ask you, Anand, is that reason to be happy or unhappy? I mean, while one can heave a sigh of relief that inflation is showing signs of peaking, as you just said, should we be happy? We be happy that growth concerns are coming to the center, because the prospect of recession in US and Europe cannot be great news for the rest of the world, can it?
No, I mean, obviously it is difficult to say that one should be happy that the focus is shifting towards growth slowdown, because it may well be inevitable and it may be too late to reverse them. And in the process of reversing, if central banks prematurely shift towards an accommodative stance or abruptly end their monetary tightening, once again inflation concerns may resurface. So it is not easy to say whether this is a happy situation or a happier situation compared to what we faced. But from the Indian standpoint, I think the decline in commodities prices caused by concerns about growth in the developed world is a blessing in disguise. To some extent, concerns of economic slowdown in the developed world will necessarily have an impact on export prospects of developing countries, including that of India. But given that our concerns were more with inflation, because we are going to have a much better growth rate than many other developed and developing countries, and we were more concerned about ensuring that inflation didn't get out of hand. The financial markets concerns with economic growth in the developed world having resulted in lower commodities prices is a welcome development from the Indian standpoint. Therefore, I would argue that in the last 4 weeks, if anything, the global macroeconomic conditions, including that of commodities prices and interest rates in the United States, especially the bond market interest rates, etc., have moved to the favor of India.
Now that point I take, absolutely, no question about that, no argument on that, Anant. So my question is this: if the West were to slow down significantly, and as you would have noted, that there has been a couple of instances of bond yield inversion in the US, which is often a reliable indicator that a recession is coming. If we do have recession in the US and Europe, or near recession conditions, how much of an impact do you see on Indian economic growth in the next 6-7 quarters?
Oh, that is a sort of a consolidated or a joint effect or a net effect of two competing forces. One is the impact coming on Indian exports because of recession, or as you put it, near recessionary conditions there. The other is that if the central banks in the developed world react to the onset of economic recession by halting or slowing their rate increases, or in some cases even reversing them, then what happens is that liquidity conditions in reserve currencies become easier, capital flows into emerging markets and to countries like India will resume, and the tightness in dollar supply will ease globally, and therefore on balance, without doing any explicit or formal modeling, I would argue that on balance it would be beneficial to India rather than hurtful.
Over the last few weeks, a lot of observers, analysts, brokerages, even global outfits have started bringing down growth for 2023, even for India. So they're saying that we'll get 7% plus growth in 2022, but in 23, some are already at 6.3%, 6.4%, and one or two have gone down all the way to 5.5% for 2023. Is that being alarmist, or do you think that might come to pass?
I'm not sure why people have sort of turned pessimistic, or rather somewhat downbeat for growth in 23-24 as far as India is concerned compared to 22-23. I can try and guess why they have done so, partly because they think the post-pandemic catch-up having been over, then there will be more moderate growth given global conditions, weak external demand, etc. But even then, I think there is an underestimation of the fact that India's potential growth is not as low as many of them might be thinking. The reason why they have probably, and this is my guess here, why they have probably lowered India's potential growth, and I happened to attend a World Bank seminar on that 2 weeks ago here in Delhi. They look at the last decade's capital formation, and that was obviously a stagnant capital formation scenario in India because companies were trimming their balance sheet, banks were trimming their balance sheet, and we went through a financial system stress. Now, if you take that into consideration and extrapolate on that basis, then potential GDP growth would appear lower. But I actually would argue that on the contrary, because we went through a balance sheet repair phase in the financial sector, both banking and non-banking, and in the corporate sector, once the current uncertainties regarding the pandemic, regarding the conflict in Europe, etc., once they fade slowly over time, I would argue the opposite, that India may be poised to kind of repeat, if not exactly in the same magnitude as we did between 2003 and 2008, India might be poised to repeat some sort of a capital expenditure and credit boom as we experienced in the first decade of the new millennium. Therefore, I am at a loss to understand the pessimism of India's medium-term growth starting from 2023.
No, excellent point, and that is really the crux of the issue, Anand, because all of us have been hoping and dreaming of this resurgence or the revival of this capex cycle, which has been missing over the last decade, but which you are hopeful and a lot of people has already begun to turn. You know, in the last budget as well, the finance minister was trying to do exactly this by shifting resources from revenue expenditure to capital expenditure in the hope that she will do her bit, the government's bit, to crowd in private investment. But let me ask you frankly, what is the evidence of the last 1 year? Do you see substantial evidence that this crowding in of private capex has happened, or to be honest or candid, that it has not happened to the extent that was desirable?
No, I think there are only nascent signs of that at the moment, and the reasons are not hard to find. We were worried about a third wave until this January, and only after January ended we could heave a sigh of relief that the third wave wasn't as severe as we had feared. I'm talking about the pandemic. And as soon as that got over and we had a good budget, which the finance minister unveiled on February 1st, within 3 weeks the conflict started, and for the next 3 months until early June or mid-June, we were witnessing rising commodity oil prices, fertilizer prices, food prices, etc. And simultaneously monetary policy tightening began to happen in the developed world starting from April or so. So naturally, despite the fact that the corporate sector has witnessed rising profitability in 2021 and 21-22, naturally they would pull back and wait to sort of invest until demand conditions became clearer. Therefore, to say that this crowding in hasn't yet materialized is to ignore the fact that we have been buffeted by temporary shocks which were very significant in nature, the pandemic and then the conflict in Europe. And that is why the government is still continuing to focus on its capital expenditure until such time that private sector is willing to go all out and use its improved profitability, improved balance sheet, improved cash position to start investing in a big way. We are beginning to see that in a small way. If you look at the bank credit growth, non-food credit growth, it's now running in double digit for the last 4 months or so. There is an appetite, and the banking balance sheets are in good shape. There is capital adequacy. Even the RBI's latest financial stability report with its stress test, etc., are showing that banks can withstand the most severe financial stability shocks, etc. So all the underlying conditions or building blocks are in place. But we have to wait for the current uncertainties to dissipate. Then I am confident that the much awaited capital expenditure on the part of the private sector, or what we call the capex cycle, will be evident in the data.
I agree with what you entirely all that you said, Anand, except with one exception, which is that when you talk to companies, they will say exactly what you said, that there were too many external uncertainties for us to unveil capex. But they will also mention that capacity utilization domestically is still running at sub 70% in many industries, and that is not giving them confidence to go ahead and do that capex. And that capacity utilization problem is not solely external. It may have some domestic roots as well, like for example high inflation actually constricting demand or leading to down trading, and these kind of demand constraints are actually leading to lower capacity utilization. What would you say to that?
No, that is true as far as last financial year is concerned, but if you look at the current financial year, I think the underlying demand conditions are beginning to improve. I think all of us have been pleasantly surprised by the resilience of India's economic activity in the first quarter of the financial year. And you can see that anecdotally as you cross airports or as you visit hotels and restaurants, etc. And also if you look at the capacity utilization in several sectors, they are picking up, and in some sectors it has even crossed 75%. So there are some core sectors where capacity utilization has picked up to the point where additional capacities may be needed. And if you look at the two-wheeler and four-wheeler sales, they have picked up also quite a bit after the slump last year. So in that sense, there are signs that both in the services sector and in some segments of the manufactured goods, there is a demand revival. But even if it is true that this demand revival is not sufficiently long enough and sustained enough for companies to start investing, I can understand that, because both the companies as well as households have both been waiting and watching to see whether the pandemic is fully sort of gone out of their consciousness, and that is not yet the case. And before that could happen, we have had the commodity price shock, which affects both businesses as well as households. So I think that is why I believe a more visible, more evident recovery in demand, and to be followed by a capex cycle will start to happen hopefully in the second half of the year. And of course that is predicated on the conflict not worsening further, on other health concerns not emerging, etc. So we are living in an uncertain world, and we have to accept that. And because of the timing of some of these things is getting a bit more uncertain and variable than we would have liked it to be. But again, I think if we go by the trends happening in the domestic economy, I would expect that in the second half of the financial year, some of these visible signs of growth in terms of aggregate demand and followed by capex will manifest themselves in the data.
I certainly hope you're right, Anant, on that front. But you spoke about the commodity price shock. Let me bring you back to inflation in India, where there are clear signs of peaking in many parts of the commodity universe. But Indian core CPI, core inflation is still running at 6%, even if you look at the month of June. Is there an element of stickiness that you see or you fear in Indian inflation? Or because, you know, what one worries about is whether inflation expectations are getting entrenched after a few months of running very high. Where do you stand on that?
No, I mean, look, forget about this cycle. You could have asked a question about India's inflation stickiness at any point in time in the last 40 years or 50 years. And in my opinion, that stickiness comes from the fact that business compliance cost, our logistics efficiencies still need to be addressed. They are being addressed with respect to the introduction of GST and the physical infrastructure improvements, etc. But it will take some time for them to again be visible in terms of data. So there is a certain stickiness, and also it could be due to the fact that the capacities in India in several sectors are very small. I mean, the Indian industry and farm sector both are fragmented. I understand that we don't need behemoths, but we do need a vibrant Mittelstand, as they say in Germany. So we have extremely fragmented, inefficient spread of capacity both in the farm sector and in the factories. So these are all the reasons for the stickiness that you pointed out. But on the cyclical side, definitely the fact that we are concerned about a 7% inflation, when the inflation rate even in Germany is close to 8 or 8.5%, in the US it is 9%, and in some other European countries it has even crossed double digits, etc., and not to mention the UK, etc. That to me gives me comfort that we are becoming intolerant of inflation, and that inflation intolerance will naturally feed into slower and more stable inflation expectations down the road. Our inflation expectations are not out of control as they were in the early part of the millennium between 2009 and 14. So in that sense, I would say India's inflation, while definitely it is above the target of 2 to 6% range, I think it has peaked, and a combination of measures, both fiscal and monetary, have definitely played their part in stabilizing expectations.
I won't ask you about monetary policy because it's unfair to ask you about your opinion on what the Reserve Bank is doing. It is doing what it is doing. But let me ask you another aspect of it, which is what the government of India is doing with its taxation policy on many of these commodities. I mean, oil primarily, you've seen the windfall tax and its treatment of excise and GST, or no treatment of GST, and in certain commodities like metals on the export front as well. Do you agree with India's taxation policy on some of these commodities like oil?
I think we have done, the government has done whatever it could under the circumstances by lowering. I think we should also take into consideration the demands are placed on India with respect to carbon taxes, etc. So we have our overall fossil fuel taxation. If you combine both the union government and the state governments, we tax fossil fuels as much as developed countries do. So in that sense, the government therefore addressing the short-term considerations, as many other governments have done, lowered the excise duty, lowered the cess amounts, and all of which fell on the union government, lowered the duties in November as well as in May. And then separately announced extra subsidies for cooking gas, and also removed similar cess on crude palm oil, etc., and made it up with the fact that the crack margin had widened so much, so and made it up to some extent with the windfall tax. So again, under the circumstances, given the fiscal constraints that India was facing, because of the nominal GDP contraction in 2021 and also the economic activity impacting fiscal revenues and the need to maintain growth in the face of private sector caution with enhanced capital expenditure, I think the government has managed all its constraints and done whatever it could and continues to do so on the fiscal side to make sure that inflation expectations don't go out of control.
We spoke about exports being hit by a global slowdown earlier, Anant. I want your thoughts on what it could be doing to India's current account deficit, which has started growing again. And while we are nowhere close to the taper tantrum period situation of 2013, what it could do to the Indian currency. I know your thoughts about the rupee is not the only currency which is weakened against the dollar, and that point is taken, and we agree on that. But what level of dislocation do you see on the current account deficit and on the currency front in the months ahead?
No, I think if you had asked me this question 1 month ago, I would have been more worried. But as we discussed earlier in the conversation, with the decline in the commodity prices, oil, industrial metals, food, etc., I'm much more sanguine about the current account situation than I would have been one month earlier. Yes, of course, there is going to be a slowdown in export growth because last year was a catch-up year and we did very well, both with manufacturing. But by the way, you must have noticed that Infosys actually upped its revenue guidance. So the services sector, IT sector exports are doing well, and therefore whatever we might lose in terms of the momentum, if not the growth rate will still be positive on manufacturing exports or merchandise exports in general, but the growth rate may be lower than what we saw in 21-22. So in that sense, there is a possibility that the overall export growth, including services, may not be as badly affected as we think because of external slowdown. But on the demand side, yes, we know the oil import bill, fertilizer import bill, etc., are all contributing to the potential rise in current account deficit to the tune of 2.8 to 3% of GDP, somewhere in the vicinity of $105 billion. And because of the monetary tightening, which usually is accompanied by flight to dollar and risk aversion on the part of portfolio investors, etc., there is concern about financing the current account deficit. But then that is the reason why, as RBI governor put it so well, that's the reason why you buy an umbrella when there is going to be a rain. So we have the $580 billion of reserves, and even if and we have liberalized some interest rates calculations for non-resident Indian deposits and debt flows, and the government has raised the import duty on gold, etc. So on balance, I would argue, even though it is a challenging situation, and that is where the incremental developments of the last 4 weeks is actually in India's favor. So I'm more comfortable than I would have been a few weeks earlier about India's ability to handle the current account deficit, because bulk of its trade receivables or trade outstandings will be rolled over at a slightly higher interest rate. It is not the government of India that has got outstandings. It is the private sector, and India risk has not been perceived to be worse than what it was. If anything, India's risk has improved, and the Fitch improved the outlook for India's credit rating from negative to stable. So you put all these things together, I think while it is a challenge, I don't think it's an insurmountable challenge for India's monetary policy authorities or the fiscal authorities to handle the financing of the current account deficit this year or next year.
Excellent talking to you, Anant, today, and I do appreciate the optimism that you have shared with us over the last half an hour or so, because we do need that. But it's excellent hearing your thoughts as always, and it was good to see you after a very long time. Thank you very much for your time.
Pleasure talking to you, Udayan. Take care.